And let's start off with the inflation report, Andrew. I know short term to be sure, but obviously a lot of people think that this could maybe set the backdrop for what we should expect out of the Fed in 2025. What do you think?
Well, I think, Alex talks about there hasn't been a big reaction. Maybe that's because the inflation numbers have come in pretty much in line and the market did a good job of successfully anticipating that in advance. I think that has more to do with it than anything. But as much as the market's not doing much today, there's a big undercurrent of change going on in the market. The winners year to date are really taking it on a chin relative to the losers. Momentum stocks have now sold off today and yesterday. And I can't help but wonder if that's the markets beginning to anticipate the Fed will adopt a more go slow attitude than they have in the past. That would cause some type of rotation out of what's worked year to date.
Well, I am curious about that because we had talked a little bit about a broadening of this rally over the last, 2, 3, even 4 months or so. Does that sort of get interrupted because of what the Fed does next, or is there going to be a little bit more life left in that trade?
Well, look, what's fascinating is in the last 5 years, the winners year to date have underperformed the losers year to date in December. It was only in 2022 that didn't happen. So, usually people wait around till next year to book gains, but the market gets in front of that and it's starting to sell off. So I think, I think that's what's going on in the markets today, and the market needs a narrative to cause that. Maybe it is CPI comes in a little hotter than expected, and the Fed is not as dovish as previously thought.
Andrew, I was checking out S&P sectors and performance for the year. With the exception of the last 6 months, financials have outperformed. But other than that, it's consumer discretionary all day, any way you slice it. That to me doesn't say a rotation.
That's true, except financials have rocketed in the last 2 months, and big tech has actually lagged. Some of these Mag 7 stocks are actually underperforming the market overall year to date. So I hear you, but if you look at the quality tech stocks, they have really underperformed the speculative junk, lower quality growth. By that, I mean companies that trade at monster earnings, very high beta. Maybe they don't have any earnings at all. That's what's worked really since this fall is a much more speculative element to the markets until yesterday.
So if we're going to be taking tomorrow as sort of a benchmark for what we can expect next year from rate cuts, how would you be positioning? Would it be more risk on? Would it be more risk off? And what's the best way to express that?
Well, I think it's very hard to say I want more risk on after a year that looks like it's going to be close to 30% in a year like last year. Anyone who's more risk on, and I hear a lot of people coming on, talking about being more optimistic, and I scratch my head because they were more pessimistic in years past. It's hard to get more optimistic. I see too many there's just a lot of speculation in poor fundamentals. So that leads me to get a little bit more cautious or defensive on next year. I don't think this is a 2021 scenario where you had this huge bubble in speculative stocks that burst and you had a bear market in 2022. But I think you have to think about what areas lagged this year, and maybe it's a little bit more defensiveness that works next year, like REITs. I think that's a very intriguing area that they're only up, the sector's only up about 9-10% for the year. Big underperformer. I think you have to start thinking about more downside protection ideas because the market has gone the other way. And we've gone from early in the bull market where people are very consumed in not losing money to later in bull markets where people are very focused on, where can I make a lot of money in speculative stocks? And that gets me a little bit more cautious.
And you've heard some folks, Andrew, that have talked about this idea of how do you protect the gains, these monster gains from 2024, 2023, et cetera. Is there sort of an income component? And I mean, I'm talking specifically being invested in equities, but is there an income component there, whether it's through dividend plays or even, I don't know, buybacks to a certain extent, that does provide a little bit more safety, a little bit more protection if the market not necessarily sells off, but if it doesn't necessarily appreciate much further than where it is right now?
100% agree. In fact, dividend yielding stocks are some of the worst performing, components this year. And that gets me more interested. People don't want to own kind of the yield. They're looking for appreciation. The stocks. There's a ton of stocks that are up well over 100%. No, I would bet most of, a very high percentage of them have no dividend. So I think the return next year could come more in a balance between appreciation and yield. So I put higher weight on yield than I have, coming out of the bear market in 2022, which in my opinion was much more about buying upside opportunities. Now it's total return as it pertains to corporate buyback. There is no question, Romaine, that following the companies that have the biggest buybacks, that's, as a strategy, that's worked. And I see no reason why that won't continue to work. So what does that mean? You're looking for companies to generate a lot of cash flow.
Yeah.
And whether that's buybacks or dividends, it's all the same. I think that's a very, very prudent strategy as I think out about next year.